Wednesday, March 11th, 2020, Maneco 64, home of alternative economics and contrarian views. So, the old lady of Threadneedle Street has cut rates almost to zero. Of course, the old lady of Threadneedle Street is the Bank of England. It's the nickname for the Bank of England. They cut rates in an emergency meeting yesterday. They announced it this morning by 50 basis points down to 25 basis points. So we're almost at zero. Before I go further, just like to let you know that I do have a mug in the Teespring store. Here it is, the old lady of Threadneedle Street. There's also a comment by the founder of the Bank of England, William Patterson. So at the front of the mug, it says, "Time to retire the old lady of Threadneedle Street and shut the bank's doors." Well, that's the end of Fed equivalent. And at the back of the mug, I've got a quote by the founder of Bank of England in 1694. He said, "The bank hath the benefit of all interest on all monies which it creates out of nothing." So should we really have an institution that has benefit of interest on something created out of nothing? I don't think so. And it's one of the reasons why the general public always gets hurt by the inflation, by the crisis, because our system is built on a foundation of nothing. So if you want to help the channel and you like the mug, go and check it out. Aside from looking at this cut by the Bank of England, of course, I'm going to look at the markets this morning, how the choppiness and volatility is continuing. Yesterday, of course, we saw a big move higher in the stock markets in the US. The previous day, we dropped 2,000 points plus in the Dow. Yesterday, we rose 1167 as President Trump announced stimulus for various industries. So much for the free market, so much for fighting socialism or communism in Venezuela and other countries, right? Well, wake up, people. We have socialism and communism in our own countries. Why would governments and central banks need to intervene in a market that's supposed to be free? Don't they trust the market? It looks like they don't. So, Bank of England, yes, cuts rates to counter the C disease shock, according to the FT. You can see here what they wrote, of course. Main bank rate dropped by 0.5% to 25 basis points, or 0.25%, to support business and consumer confidence at a difficult time. Well, I made a video, let's see what it was, back on the 17th of February. And I said the central bankers are helpless in their fight to avert economic slowdown. I think all this is going to do, of course, it's going to create stagflation. You're going to get the slowdown no matter what. People are not going to spend more or travel more just because the Bank of England cut rates by 50 basis points. If they don't travel as much or spend more or go out as much, the corporations that would normally benefit from a stimulus like that, they won't get that benefit. So all the Bank of England is doing is debasing its currency, which means higher prices of everything. It's not going to help. That's stagflation. That's why you need to be, if you're fortunate enough to have savings in the bank, you need to think about converting that into real money, gold and silver. Billy, as you see, is guarding his silver bar. That's why he's always so calm, always asleep. He's peaceful because he's protected by silver. Let's go through the story then. FT says the Bank of England has made an unexpected cut to interest rates in response to the economic shock of the C disease. Well, yeah, they were supposed to meet. Their meeting's supposed to be March 26th, their scheduled meeting. I'm not really surprised they've done it before. They're just following the Fed. Says the Monetary Policy Committee unanimously agreed to reduce the main bank rate by 50 basis points to 0.25% at a special meeting ending on Tuesday. Not sure what time that was, but it was announced this morning. The reduction in the bank rate will help to support business and consumer confidence at a difficult time. This is what the bank is saying. To bolster the cash flows of business and households, to reduce the cost, and to improve the availability of finance, the bank said. The UK Central Bank follows the US Federal Reserve in taking unscheduled action to combat the expected economic disruption from the disease or the virus. The bank says it has seen a marked deterioration in risk appetite in the outlook for UK growth, and said indicators of financial market uncertainty have reached extreme levels. They're not wrong about that. It said that while the magnitude of the economic shock is still highly uncertain, activity is likely to weaken materially in the United Kingdom over the coming months. The other thing they note in this article, and this is more stimulus as well coming from the government now, it says the rate cut comes as UK Chancellor Rishi Sunak prepares to unleash the largest rise in public borrowing in 30 years when he delivers his first budget on Wednesday, signaling a decisive end to austerity as he pours money into long-term investments. A couple of things. This new Chancellor, Rishi Sunak, he's an ex-Goldman Sachs boy, right? And the other thing, I would say long-term investments, I would read spending. Governments don't invest, they spend. So this is another reason to be out of paper, to be out of fiat, because what does more debt mean? It means more fiat currency. We know fiat currencies are backed by the government debt. And I bet you the Bank of England is going to oblige, and they're going to come out and start buying that and call it asset purchases, which is basically they're going to print the money out of thin air, as the founder of the Bank of England said. They're going to print it out of thin air and have the benefit of all the interest, right, on that money. And why are they going to do that? Because in a free market, with where things are, with the budget deficits that we're still running, with the amount of debt, over 100% of GDP, public debt, the market would normally not be confident to buy this flood of government debt, the flood of the issue of government debt by the UK government. And that's probably going to keep, unfortunately, rates going lower, even into negative. I think the other day, UK rates up to 7 years went negative, the yields. But one thing I would say, if you look at John Exter's pyramid, eventually, in the deflationary collapse, all the liquidity flows to the safest monetary asset of all, which is gold at the bottom. And John Exter was a central banker, so he should know what's the safest monetary asset. It's not paper, it's not government debt, it's not T-bills, it's not Federal Reserve notes or Bank of England notes. The Chancellor will also turn the spending taps on in the short term to help the NHS, companies and individuals cope with the outbreak of the C disease, further increasing the UK government deficit. So he's going to help companies and individuals. How can he do that? Governments, we know, don't create wealth. They don't earn money. Well, they're going to take it from certain individuals and give it to others. So it's not going to help Mr. I forgot his name, Sunak. He's just been appointed as Chancellor. He's quite a young guy. Hadn't heard of him until a few months ago. It ends the article by saying, the FT, Mr. Sunak's proposed increases in day-to-day public spending and infrastructure projects over the next 5 years will mostly be funded by borrowing, jeopardizing the government's stability to meet fiscal rules it set only 4 months ago. I always go back to 2010 when George Osborne, the then chancellor, said that the UK would have a balanced budget by 2015. I didn't believe it at the time. And there you go. The deficits and the debt are going to keep growing forever, unfortunately. And that's why if you are fortunate enough, as I said and I repeat, to have savings in the bank or anywhere else, national savings that you think are safe, yes, they might be safe in the national savings. Government guarantees it, but they won't be safe from the loss of purchasing power. So yeah, check out my referral code, Maneko64, at goldinvestments.co.uk, oldest bullion dealer in London. If you are thinking about acquiring gold or silver, you get a 0.5% discount off the offer price. I've been dealing with them since 2002. Check others as well. Don't only check Gold Investments, but I have a referral code there. So with that, let's look at the markets, see where they are this morning. It's 7:51 a.m. London. Of course, yesterday is a huge rebound. Well, half a market gain, just over half the losses from Monday. The Dow, that is. Right now, the Dow is down 650 at 24,377. So down 2.5%. So as I said, it's going to be choppy and volatile. When will it bottom? Difficult to say. But I think as I said yesterday, I think we're not out of the woods yet. I think we're going to break the recent low we made this Monday and go further down. S&P is down 2.7% or down 78, just above 2,800, 2,807. NASDAQ 100 future down 2.5%. Precious metals, gold got hit particularly hard yesterday. As I said, I'm not concerned. Right now we're up just under 1% at 1663, or up $14. Silver's up 15 cents at 1703. Sterling, surprisingly, is not really moved that much despite the rate cut. We're at 129.05, down slightly. The euro is up 0.5% versus the dollar, 113.37. Yes, we saw the dollar rally yesterday a little bit, so we'll have to see if that continues. It looks right now that when markets drop and yields drop, the dollar has been going lower. Yesterday was like a counter trend move, I would say. The dollar's down almost 0.2% against the yen, just below 105, and the dollar's down 0.1% versus the Chinese currency at 695.60. WTI crude is down 0.3% at 34.38. The 10-year yield is down 8 basis points at 67 basis points. So yes, yields did rise quite sharply yesterday. On Monday, they got down to around 34 basis points. So not surprisingly, the central bankers, the governments, don't trust the markets to solve problems, and they're starting to intervene. And I'm not surprised because they're all Keynesians. They don't believe in free markets. So the central bankers are going to flood the market with liquidity. They're going to cut rates towards zero or probably even below zero. And governments are going to start spending more. And it's not like we don't have enough debt already. The U.S. is about 107% of GDP, the public debt. It's running almost at 24 trillion. The UK is also running over 100% of GDP. So, yeah, it's going to get even worse. And for those people who are pumping their funds into government bonds, they need to be careful because eventually all that liquidity is going to evaporate and going to flow into cash, into silver, into gold, into real assets, as John Exter said many, many years ago. So yeah, right now it looks like the government bond market is a haven, but believe me, it's far from a haven in the long term. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to the channel if you haven't yet. And you can also follow me on Twitter, Facebook, BitChute, Steemit, and DTube. I wish you all a great day. Take care. Bye.